Welcome to the daily update, where I'll go over the action in the market for Monday, December 30th, and we'll see how things look for Tuesday, December 31st. This will be, of course, the last video of 2024. The next video that I prepare will be for the new year, 2025. Well, we saw another decline. It appears like Santa Claus is just not showing up. Now, if you remember back to a year ago, we went through kind of a difficult time during this part of the year as well. But then January ended up being positive, and of course, even if we decline a little bit more in the last day of trading, we're still going to be pretty solid for the year of 2024. So it doesn't mean all is lost, but we're not seeing small caps kicking into gear. Mid caps are having trouble. We're showing really weak market breadth right now. We're switching back more negative in the short and intermediate term for the S&P. Now the 50-day moving average, which acted as support on Friday, is now acting as resistance, at least on an intraday basis. So yeah, a lot of this just taking the market for granted. The market doesn't like that, and it's defying a lot of those attitudes right now. Okay, there's a thing called the SPX Investing Program. There's still a day left if you want to go check it out for free. There are additional videos that I post there. You get immediate access to the videos. I'll be rolling out a bunch of courses in 2025 and doing additional videos. You can also set up times to talk with me, and I act kind of like a coach sometimes, maybe more like an instructor. I don't tell people what to do. I try to really promote the idea of people learning this skill for themselves, but I come alongside you to help you understand the different parts of the markets and then help you to develop this critical thinking skill for yourself. If you want to check that out, please feel free to do so. You do get immediate access to the videos as they are available. If you have any questions, you're more than welcome to send me an email. Also, I prepare a number of different videos, especially over the weekend, but every day I do a daily video, and everything that I do ties into the daily video. Okay, let's go back and talk about what happened. We had a gap lower open. The futures were, well, kind of unchanged to slightly negative, and then as we got closer to the open, we just drifted lower, 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 lower. We ended up having a gap lower open below S1 at 59.34, and then prices quickly fell down to S2 at 58.97. So we broke through the 5900 level. We found support at around 58.70. Then we rebounded back up above S2, but then we hit resistance at S1, which was also the 50-period simple moving average. Then we chopped sideways after that and closed down below S1, but still above S2. We were down 1.07% on below average volume. We're still in holiday mode there. We are now negative in the short and intermediate term as measured by the moving averages. We're still positive in the long term. The improvements that we were seeing starting to build last week, some of them are still there. We're still looking okay when we look at growth versus value, discretionary to staples, even though they're taking a bit of a hit. But our indicators that we look at that were showing these signs of improving are now switching back and looking more negative. Of course, you've got a holiday, and this is a worldwide holiday. I know China has their Spring Festival, and they'll officially have their New Year at the end of January, but a lot of markets will be closing early. The US is open for the entire day, New Year's Eve, but will be closed New Year's Day. There's always some kind of fear that something weird could happen, and we'll just kind of take that as it comes and just see how the market ends up reacting to that. Some comments. It was another day of broad-based selling, and the S&P ended up finding resistance at the 50-day simple moving average. So far, it still just looks like year-end selling. And even though interest rates came down on Monday, we're still above that 4.5% level with the 10-year yield. And that's causing some concerns, and that's biting into corporate profits. And the market's going, wait a minute, we don't like these higher interest rates. And there was also an announcement of a Chinese-backed hack of the Treasury Department. Not sure if that really means anything or not, but the Treasury Department is connected to the stock market, so We just want to be aware of that. There's still this confirmed Hindenburg omen that's on the books, and that's negative. And then on a short-term basis, we're starting to get extreme negative with the 20-period exponential moving average. We've already been there after Friday's session, but now our list is getting a little bit longer. The CCI 14 and 20 are extreme negative. We're back down to extreme negative with the McClellan oscillator for the S&P after it had actually gone positive after last Thursday, dropped back negative on Friday, and now is extreme negative again after Monday. In our 20 period simple moving average study, and I'll have charts of all these to show you, in the intermediate term, we're getting a little more crowded with that chart. With the PMO studies, things are looking extreme negative, and we're dropping back down with the 50 period simple moving average study. No change to the scenario. It's mainly about interest rates going up right now, and the Fed has come out and said, well, we're not going to cut rates. We're going to pause for a while. And we're also going to increase our inflation outlook. And that's kind of fed over into this more negative scenario that we've been seeing since the last Fed meeting. The dollar was up and interest rates were actually down. We closed at 4.55% with the 10-year yield, where after Friday we were at 4.62%. Sentiment is negative. We're at 28. We're not extreme negative. That won't happen until we drop under 25. And that's when we start to look at using this as a contrarian type of indicator, where after Friday we were at 34. We're still not trending as far as being measured by the ADX. We are negative, the red line going up and the green line going down. We're also below the moving average. Now, in the short term, the ADX is starting to turn up a little bit. If we still see more weakness, this could shift over into a negative trend, where right now we're not trending and the bias is negative with the down day, and we're more mixed to negative. You might even consider that to be negative. We've seen two pretty significant back-to-back down days, Friday and Monday. We did get the Chicago PMI. It came in at 36.9. That's weaker than the 42.7 they had expected, and it was down from 40.1 last time. Pending home sales were up 2.2%. That's actually quite a bit more than the 0.9% increase they had expected, and last time it was up 1.8%. Here's a chart of the Chicago PMI where we're going down here, and this is showing economic weakness more in the Chicago Midwestern area. Here's a month over month look at the pending home sales, which did increase, and year over year, we're also seeing an increase as well. And looking at this, and I included the description here from Isabel Net, S&P 500 index max pullback per calendar year. Basically, what they're saying is that the declines that we've seen in 2024 are not, they're a lot less than average. And so usually we see a decline of about 14.2% if we go all the way back to 1980. So this just means, folks are just getting used to buy the dip, pull back. Oh, we're going to bounce off support and continue to go up. Well, the market is shaking things up a little bit and causing people to have doubt and fear. This could suggest that there might be some more downside when we get into 2025. And then strategists chase the rally, and that's true. The charts that you see when we're going up are all positive, and they think we're going to go to the moon, and they think that we're just going to continue to go up. Then we go through a week time, and all the charts are doom and gloom, and that's just the way things go back and forth here. Then looking at ETF flows into bonds, where if you look at the high grade bonds, these are more conservative and going across the world, not just within the US. We're seeing a lot of money going into that. But then in the emerging markets, we're pretty much flat. And then the global high yield, these are, we know them also as junk bonds, where we're starting to see some more money coming into these bonds because they give a higher yield, and folks are willing to take that risk. And banks outperform S&P 500 and the NASDAQ 100 in 2024, coming off the weakness that I was trying to point out. And we're still positive with the financial sector, but here we break it down into the banks. We're coming off of those readings, and I was kind of concerned about that weakness, but we seem to be holding up for right now. But if you compare these different parts of the market, the banks actually outperformed, at least as of this chart. Of course, we still have one day left. And then We look here at gold stands out as 2024's top performer in the metal sector. Not so much compared to the stock market. It still had a really good year. But if you compare it with other metals, got to get me some of that iron ore, baby. Some lithium, yeah, all right. But gold is doing about the best here. Then spend a little bit of time on Twitter here. Now, everybody's expecting this Santa Claus rally or the January effect, whatever you want to call it, for small caps to go up, and they just keep going down. Now, there we still have the window of time for that to happen, but this is put out by, well, it's a Bloomberg chart here, but I also saw a similar study put out by Sentiment Trader, or if you took $1 in the small cap and compared it to the large caps over this favorable time, this season that we're in right now, you would see that the black line, those are the small caps, how it would have grown over a period of time versus the blue line, which are the large caps. And this is what people are trying to anticipate and get ready for. This next chart just shows that we're seeing a real pickup in options. And if you trade options, you like this because when there's more volume, the bid ask spreads are a lot closer to each other. It's easier to get in, get out. If you do more complicated strategies, you can just hit a button and be filled or get out of that particular position. So this actually is better, where it's the stock market is one of those rare things where the more the merrier works to your advantage. And so the bigger the volume, the better it is. Then the monthly market breadth is on pace to hit an all-time low in December. We'll see. We still have a day left here, but and this isn't necessarily negative for the market. We're seeing it right now, and it is negative over the last few days. But sometimes once this gets beyond this period of weak breadth, sometimes we see some really nice bounces. But we also just don't want to assume that because this can also mean that the market is showing some weakness and could lead to some more declines. Then we are seeing a lot of credit card loan defaults. They're really going up now, not as high as they were back during the great financial crisis, but it's still happening. And then the U.S. Treasury says it was hacked by a Chinese state-sponsored actor. They were able to remotely access certain unclassified documents. And this happened on December 8th. So, yeah, thanks for telling us right away when that happened. And then what is contributing to the year-to-date gains in the S&P? And no surprise here, it's technology, communication, and then financials are strong and discretionary. And these are the areas. Financials kind of come and go, but the big three growth areas are discretionary, communication, and tech. When those do well, the market does well. That's why I really focus on these things. And these three areas are growth areas. So that's why we do a lot of studies between growth and value. Feeling merry. A lot of people think that, yeah, over the next year, the market's just going to magically go up. Well, let's see. When you've got a lot of people thinking, especially when it comes to the stock market, that a certain thing is going to happen, quite often the opposite ends up happening. And where is Santa Claus right now? Good old elf here, being really excited as we started to get into Christmas Eve and go into what will be the first two trading days of 2025. Now, not looking quite so happy. Okay, so we gapped lower down below S1 right at the open. We quickly went down below S2. We found support down here and we were able to build a bit of a base. Then we came back up above S2. Now, S1 was right about at the 50-day moving average. So we saw a convergence of that. And we kind of chopped along this level and then drifted off going into the close. And you can see when we initially opened up here after the weekend, we were pretty much flat. This pink area, this is Sunday afternoon or evening. And then when Europe opened, that's when things started to take a turn and we started to drift down. We're still before the market opened, and then we did open with the market and just saw things continuing to fall. We did get a nice little bounce here, but we closed not only well off the low, but also well off of the rebound that we saw during the day. We're down just a little bit in the initial overnight session for Tuesday. This is still holding up, though. We still see the blue line above the red line when we compare large cap growth to large cap value on an intraday basis, even though they both have been taking a hit here. This also been going sideways, but holding up for the most part. If you go back to the latter part of November, we've been seeing an intraday growth to value ratio in here with the S&P doing quite well. And then on an end of day basis, growth was down, but down less than value for the large caps, down more for the mid caps, and down a little bit more here for the small caps. And this is, folks are like, okay, let's buy me some small caps. And we just keep going down, 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 down. We're actually setting a lower low here from what was set previously. Now, we're still positive with this ratio between small cap growth and value, but we are coming back now. And we're seeing kind of that same thing here. The index for the mid caps just not doing well right now, but growth to value on an end of day basis is still positive. And we're coming down here with S&P growth to value, but still positive this way. So these are holding up for the time being. And after really setting a new high here with the growth to value measurement with these ETFs, we are coming down, but still holding up. And discretionary to staples coming down, but still holding up. So these are some areas under the surface, but I've been pointing this out. It just has not come through in the form of price action. Large cap growth was down over 1%, but still coming in above their 50-day moving average, where we're below the moving average with the S&P 500. Here's our trend. This is intermediate term where we're seeing the red line going up and the green line going down. That's negative. And we're turning back up here with the ADX, but we're still below the moving average. Now, when you look at the short-term chart, also more negative with the red line going up and the green line going down, we could see a cross here above the moving average and going back above 20. So that could signal a strengthening trend. And with the red line on top, that would mean a negative trend. And we're quite below average with volume. This is kind of one of the reasons that you would think that things are holding up fairly well is because volume is really dropping off. So we're not seeing some gargantuan volume selling, at least right now. We're going down with the indexes, but it's not a lot of the smart money that's really coming in and doing the selling, which could give the market some hope. As far as sentiment, it's really dropping down here. We're at 66.63 here. We're still looking positive in this composite. We just look at this once a week, and I don't rely as heavily on this one. We are going back up here with the Ulcer Index, another sentiment gauge that's showing fear. We keep a really close eye on the VIX. We're crossing back above the moving average, both with the line chart and the bar chart, and we're going up with the VIX of the VIX, above the moving averages with both. And we're right on top of the moving average now. It looked like the VIX was really starting to come down. The momentum was shifting over, but we haven't quite crossed over negative yet as the VIX has been going back up. And the seasonality, okay, where are we here? We're coming up to the very right end of this chart, and we're actually going up with the VIX instead of it actually coming down, which typically is what happens. Still getting a high reading, but dropping with the skew index. The market is still anticipating some kind of a big move that hasn't happened yet. We ticked down just barely, just a virtual unchanged reading here with this fear gauge, where we kind of went up pretty significantly with this other fear gauge. And not seeing much of a change here. We were down 0.5%. We've been bouncing around here when we look at the risk on to risk off ratio. We want this to go up. It's been chopping sideways lately. And we actually ticked down a little bit with the equity put call ratio. This may go up a bit. This is just pure speculation on my part. Ahead of New Year's Day, ahead of the market being closed. So there might be some folks that put on some hedging ahead of that in case something happens. But we're still going up with the 5-day. And here's a longer term look at the 5-day, which tends to be negative, and we're barely going up. We're not showing any real conviction here with the 10-day. That's why we get this change from day to day to day, because we're just chopping around right now. There's really no conviction. And we're not seeing a real increase here with the volatility risk premium, which projects out about 30 days. We're still below this band. It's coming back up a little bit, but still not anticipating a lot of fear according to this. Okay, so we're coming back down, but still above the moving averages with the advanced decline line based on price and volume. And you can see we had pretty significant downward price movement. Not so much with volume here, but we're getting kind of extreme both in Friday's session and again on Monday's session. And we're showing a bit of an expansion of the new lows. Really no new highs here. We were trying to turn up with our 5-day, but now it's starting to go back down again. And we're leveling off a little bit, but still declining with our 10-day moving average. And we're going back down below zero with the advanced decline ratio, both the blue line and the red line. That's short and intermediate term. And we were seeing a little bit of an improvement here with the advanced decline ratio, but we're going back down below zero. We're also declining below zero based on volume. And this really isn't moving all that much here. Maybe it's the drop off in volume, but you can see the boom indicator shows that we're going down. So we're, but if you look at this, it looks like we're barely above the moving average. But I would treat this more as neutral with the smart money indicator. We're also going sideways here with the chicken money flow, which could end up being positive. It just means that there's not a lot of conviction going on right now. And the red line continues to decline to go sideways as well. So this is, you might lean a little more negative because we're seeing the red histogram here. This is still positive, even though it's rolling over. So we're getting a mixed signal with our smart money indicators. We actually went up after Friday's session. We were rolling over, but we're still above the moving average here after Monday. And the vortex shows the red line going up and the green line going down. That's negative. Seeing a continuation of this negative action with the cumulative advanced decline line based on price for the S&P. And we're kind of wondering, is it going to drop below this previous low where we still have a little ways to go here based on volume? We're negative here when we compare the S&P 500 with the NYSE advanced decline line. And this is longer term negative, the 10-day average of the highs and lows for the S&P continuing to decline. And when we look at the broad market, we're below the moving average with the cumulative advanced decline line for the NYSE, also below. And now the moving average is starting to roll over with our regular NYSE advanced decline line. Seeing that same thing with this other NYSE advanced decline line. And we're continuing to decline here with the common stock on the NYSE as well as volume, but we're kind of going down a little faster based on price than we are with volume. That could be something positive just to be aware of. We're still seeing a deterioration here with our advanced decline line studies, below the moving average and declining with all of the indexes. This is longer term and a broad market measure of the 5 period moving average of the highs and lows. We're still below zero. And these are the stocks inside the S&P above their 20-period moving averages, going back down and getting an extreme reading here. Coming back down, we're dropping below 10. Now, last week, we saw another drop down below 10, and then we started to bounce up off of that. Will this end up leading to something? Not quite yet. It's still negative until proven otherwise. And we're getting a very low reading with those stocks above their 50-period moving averages, declining with those stocks above their 100-period moving averages, but yeah, we're still below 50. We're still above 50 here with those stocks above their 200-day moving averages, but we're also declining. We look at a ratio between large caps and small caps, not much of a change here. When this was going up, that means the large caps are outperforming. And maybe on a 1 day basis with the advanced decline ratio, we possibly overdid it. We were pretty extreme there. It's hard to see this, I know, because we have the new pivot points coming in for January. We're below the 50-day moving average now. And even though volume picked up, it's still below average. We're getting extreme negative with the 20-period moving average study of the S&P. We're declining but not extreme with the 50 and declining with the 200. Declining with the Stochk RSI. This is a short-term indicator. Also declining below the midpoint with the Williams percent R. Now the CCI 14 starting to drop into this extreme negative area, as is the CCI 20. We're not extreme with the stochastics. We've been bouncing around enough that these things really don't know what to do. We're going down with the short-term stochastic, declining but still above the midpoint in the intermediate short term, and we're still going up with the long short-term stochastic. We're dropping below zero with the force index, so that's turning negative. The condition of the short-term trend is measured by 20 periods. We're below the lines, and the lines are starting to go down. That's more negative. And we're below the 20-period simple and exponential moving averages. That's what's turned the short-term trend to negative here. And we're dropping further below the midpoint with our standard deviations chart, and we're just kind of starting to go into the -2 channel here. And we actually ticked up a little bit with the balance of power, but we're still below zero. We're negative with the go, no-go system with the brown bars. We're dropping further below the midpoint here with the lowest low value now winning out, but we haven't come down to this red line yet. The TTM squeeze continues to be negative for right now anyway, with the darker red and going down. We're coming down a little bit with standard deviation, but we're still above the moving average. That's measuring speed. And we're negative with the ease of movement. Here, we're the Arun, it's on vacation or something. It's just not really picking up anything. After going positive after Thursday, we're now extreme negative with the S&P McClellan oscillator. So that's quite negative. So that's turning the summation index based on price and volume back down after it looked like we were seeing signs of an improvement. And we never did get up to zero or back to positive with the NYSE McClellan oscillator here, and we're going back down. So the summation indexes are declining based on price, and it looked like we might have been setting some kind of a base here after Friday. Not, we're continuing to decline now based on volume. And this was one of the more encouraging charts that we were seeing, the Swenlin trading oscillator. Even after Friday, it was above zero and going up based on price and volume. Not now. They're turning down. Now, they're still technically positive since they're above zero, but the fact that they're declining is a concern. Momentum is negative with the PMO going down. We were trying to show a bounce or a little bit of a recovery here based on price and volume, but now both of them those are turning back down. We're getting extreme negative with the PMOs that are rising, and we're continuing to be extreme negative with the buy signals. We continue to decline with the PMOs above zero. Short-term momentum, we're getting down to this red line. Now, we could still go further than that, but this is usually the area where we start to get extreme negative. The MACD, short to intermediate term, it was trying to turn back up, now is starting to go back down. All of our momentum indicators in the short term, intermediate, and long term continue to be negative. The Copic curve continues to be negative. We're back into this kind of yellowish area and going down. So that's more negative with the Sean trend meter. Ticking up a little bit with the money flow, but still below 50. So that's still negative. Actually crossing above 50 here with the ultimate oscillator. Has no reason to do that, but it's doing it anyway. And coming down, but still above the moving average with on balance volume. We're dropping below 50 with the RSI 14 and 9. That's showing the short and intermediate term momentum is turning more negative. We're negative with the Elder's Impulse system when looking at the S&P, but we're still positive with the parabolic SAR. We might have to come back and take out this low. This is a chart pattern that we're watching here because if we bounce back up and then go back down and set a lower low here, that's going to be pretty negative is when you look at bar patterns on charts because that's a series of a lower high. And then if we do make a lower low, that's negative. So we're going to be watching this previous low. This was the Fed freakout day that we saw here. And actually, no, it was a few days after that. But we'll be watching this just to see if we break through even on an intraday basis, but especially on a closing basis. If we take out this low, it's probably going to turn this parabolic SAR chart negative, and it's going to just make things not look very good right now. Now, we could recover from this. We haven't taken out this low yet. We could go back up, and we're probably going to have to set a new all-time high here to really negate what we're seeing right now. Also, the 50 period moving average, the intermediate term, the is looking more vulnerable. We came right back up to the red and blue line. Now we're starting to go back down. And we're below the 50 period simple and exponential moving averages. That held on Friday. It did not hold on Monday and acted as resistance intraday. So now we're just keeping an eye on the 100 period moving averages to see if we get down to that level. So we're below the 20, we're below the 50. Short and intermediate term trend is now negative. And we continue to decline with the bullish percent index, and we're below 50. That's negative. We're back to declining with the NYSE bullish percent index and back to going down with the NASDAQ 100 bullish percent index, coming back into the top end of the cloud. Now, we came into this not too long ago, and we're able to bounce up out of that. Is the same kind of thing going to happen? But this whole area is considered support when you use this Ichimoku cloud. We're also looking more negative because the blue line's below the red line and the green line's going down. That's really hard to see because it's kind of mixed up with the bar chart here. And I've been trying to point this out for a while that we were coming up to the top end of this trend channel, which is positive, but we're bouncing down from it. That's more negative. And we're negative with the Heiken Ashi turning black with the candles there. We're pointing down and negative with the Kegi chart. For some reason, we're still positive with the Renko chart. and we're negative with the three-line break chart. So longer term, seeing a bit of a hit now with the 150 and 200 period moving averages, but still above these blue lines here. And we're watching this too. This could end up being positive if it happens. We had an extreme negative reading with the NYSE Brett thrust here, the ZWAG NYSE Brett thrust, and they came back above zero point 0.4. And now we've got to get up to this red line within 10 trading days. We're going in the opposite direction. Now, this is Friday's reading. There's a 1 day lag with this chart. This is probably going to go down even more. Who knows? Maybe we'll go down to this zero point 0.4 level and then be able to thrust up out of that. Pure speculation at this point. We don't want to front run this. We want to wait and see this actually happen. All right, so we're negative in the short term with stocks and bonds based on price. We're negative across the board. Commodities have switched back to positive in the short term, and the dollar is just doing pretty well right now. Negative in the short term across all of the indexes. We're negative in the intermediate term with the mid caps and the small caps. They're supposed to be going up, and they just keep going down. All of the sectors ended up being negative, with discretionary being down the most. Tech got hit pretty hard, and communication was down over 1%. And everything was pretty much negative. Even with the dollar setting a 2-year high, that tends to be negative for the market. And then we crossed below 5,900 with the S&P. Then we went 19.7, 19.6, 19.5, 19.4, blast off. Okay, and we're showing where we're continuing to decline here when we compare the equal weight version with the weighted version of the S&P. The fact that this red line is going down further than the bar chart just means the equal weight version is underperforming. And we came back virtually unchanged here. And when this ratio is going up, that means the weighted version of the S&P is outperforming. And that's what we had been seeing, but neither did very well on Monday. The Dow is still positive longer terms since the 50 period is above the 200, but we're below the 50 period moving average and now breaking below this pivot point. And we're negative with the Elder's Impulse system for the diamonds. Hard to see this because of the pivot points, but we're still holding up a little bit better with the NASDAQ. And the NASDAQ 100 also hard to see here, but still above their 50-day moving average. And we're negative, though, with the QQQs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 continues to be negative. And we dropped down below the 20-period moving average with the Qs. That had been an area of hope that I pointed out over the weekend. We came down below that, but we're still above the 50-period moving average. We broke it on the S&P, but we have not broke it here on the QQQs, which is the ETF for the NASDAQ 100. And just not doing very well. Down 0.72% with the small cap index. And then we look at the other small cap index, the Russell 2000, going back down with the RSI, well below the 50-day moving average and just chopping around here with the price. Momentum continues to be negative, but we're still neutral when you look at the Elder's Impulse system for the small caps. Mid caps also below their 50-day moving average. They hit this pivot point that seemed to provide overhead resistance, and we've been coming back down. But one thing that's encouraging, if you go back here, you look at the small caps. We closed well off the low there. We're also seeing a close well off the low here with the mid caps. So we did see a bit of a bounce intraday there. We're still neutral with the Elder's Impulse system for the mid caps, and we lost the 50-day moving average with the Wilshire. We're also falling back under the 50-day moving average with the total U.S. stock ETF. Financial sector, which is still positive. This has been one of the better areas in 2024. It's going further now under its 50-day moving average. The FANG index holding up fairly well, down over 1% again, but still above its 50-day moving average. And we hit this short-term trend line here and just cannot seem to get above that. And now we've been coming back down. Apple was down 1.33%. We had Microsoft down about 1.33%. We had Amazon down over 1%. Google down 0.79%. Meta down almost 1.5%. Nvidia was up. It was down earlier in the day, but saw a nice little roaring comeback there and still hanging out around its 50-day moving average. So this chart's holding up a little bit better. Tesla was down 3.3%. Netflix was down 0.78%. So when you get all these big stocks down at the same time, that's why the indexes fall. And we're still seeing a negative versus a positive side here with the semiconductors. When we look at the SOX index, we're falling down below the 50-day moving average and we're seeing a downtrend here. And we're just kind of chopping around when we look at the semis to tech ratio. No real conviction going on right now. And not much of it. Well, I guess we did come down almost 1%, but we're seeing the ratio between the semiconductors growth versus Dow value. We want this to go back up. And it hasn't really fallen apart, but it's not showing a lot of strength right now either. But when you look at the SMH semiconductor ETF, we're still above the 200-day moving average, and we're still in an uptrend, even though we're going sideways. And here we're coming back into the top end of the rainbow, not showing any real conviction there. And seeing a bit of a deterioration in the short term between US and world stocks. It's kind of starting to show more of an improvement now with the longer term correlation. The dollar continues to be strong. We didn't close in the 108 range, but we got above that for a while in Monday's session. We did come down with the 10-year yield. Now, that would be nice. If we could see this really start to show more of a trend coming down, that would really help stocks. If we turn and go back up, that's going to be more negative. And we went up with the 10-year based on price. This is a concern, home construction versus the 3 to 7 year bond. We're continuing to go back down after dropping below the 250 period moving average. Seeing a little bit of weakness here, but still above advancing moving average when we look at the Qs to S&P, discretionary to S&P, and large cap growth versus large cap value. So the large caps still above the moving average. The moving average is still going up, but we're coming down to the moving average with the mid caps, and now we're starting to fall below the moving average with the small caps. So what's our outlook? We're still in this period called the Santa Claus Rally, which started Christmas Eve and will go until Friday, January 3rd. Supposed to be a good time for the market, but a year ago it was not. But January was, and we ended up having a very good year. So not all hope is lost, no matter what happens. The stock market will be open all day on Tuesday. Now, we closed early on Christmas Eve. The market doesn't close early for New Year's Eve, and will be closed January 1st. And then there will be a state funeral for President Jimmy Carter, who passed away. It will be held on January 9th, and that's since it's a state funeral, the stock market will be closed that day. Technicals just show the weakness is continuing. We're going to get the FHFA housing price index, the S&P Case-Shiller home price index as well. A lot of housing data on Tuesday, and consumer confidence. We'll see how folks are feeling about things, and then all the geopolitical things. Now, one thing to just keep in mind is that we do have a state funeral coming up, and there's going to be world leaders and important people from all over the world. They're all going to be in Washington, D.C. on January 9th. You got a whole lot of power in one place at one time. Let's hope nothing crazy happens. All right, and then I have some purple on here because I'm getting a mixed picture between the economic calendars that I look at. We're going to get Tuesday looks okay, and then we'll be closed. But they had the MBA mortgage applications coming out with the market closed. So this will probably be adjusted as we go throughout the week. And then we'll be closed on Wednesday. Seasonality neutral to negative with the Dow, and we're just flat out negative over the last 21 years with the S&P and NASDAQ. So not really looking good seasonally there. But we tend to be positive during this time. And if you look at this chart, everything suggests that we should go higher. The only problem is we're not doing that. And then we have one day left here where we typically see in a longer term picture, the green dash line tends to go up for the last day. And then the small caps, which should be just skyrocketing now, are actually going down. And Tuesday is in 2023 was a flip of the coin, whether it was positive or negative. It was the least negative day up to this point in 2024. The positive seasonality, just not, it's a real disappointment to a lot of folks. And then this just shows since the election and then going out a year after that, that once Trump comes into office and the new administration takes over, based on what happened last time, and then comparing it going back to 1960, do we have some positive seasonality there? And we still have one day left. It's going to have to really go up to be positive for that. Small caps just not really participating to this point. Now, there's still some time left. This can go through February and even into March. So there's an opportunity for small caps to go up. It's just when everybody thinks that's going to happen, that's usually when it doesn't happen. All right, and then we've seen this chart before, but now I'm highlighting January, where we're up 58% of the time. That's a little over 50%. So you can kind of toss a coin there with a return of 1.1% when we are positive. And then we're still seeing some mixed signals here with our smart money indicators. Accumulation distribution, possibly neutral right now. Chaikin money flow is flat and probably slightly negative since it's below zero, or the chicken oscillator rolling over but still looking more positive. So we're getting a mixed picture there. We're seeing weakness with the advanced decline lines. We're seeing our 5 and 10-day equity put call ratios going up. Both the S&P and NYSE McClellan oscillators as well as summation indexes are negative. And we're negative with the momentum. We're negative with the bullish percent indexes. We still have a confirmed Hindenburg Omen. The vortex is negative. Our moving average studies are negative, except for the 200 period. The ease of movement and the money flow, no, it's the ultimate oscillator. That should actually be on the positives. I don't know why it went up, but it did. And it's actually turning positive. We'll see. Maybe it's some kind of diamond in the rough signal that we're not really paying attention to. And the momentum, and this had been improving. I should have taken this off. The momentum for the NASDAQ 100 is still negative. Positive signs. We're still holding up fairly well with growth to value and discretionary to staples. And the Swenlin trading oscillator, it's positive, but now it's turning back down. Parabolic SAR is still positive, and we're still positive with the 200 period moving average study. In the financial sector, it's getting hit with everything else, but it's still positive. And then we have an updated chart here with no additional spikes, at least yet. We'll see if we get any with all this downward action that we've been seeing. So our conclusion, the weakness continues. We're supposed to be having positive seasonality, but not really seeing much of that. But the large caps and growth are still holding up. We are negative and showing weakness in the short term. We're also negative now in the intermediate term with the 50 period moving averages acting as resistance. Long term, we still continue to be positive. Thank you. Have a really good day, and I will talk to you in the next video, which will be in 2025.